Today I took the biggest L of my trading career and lost over $9,000 in order to save my Tesla shares. Tesla, as I speak, is going straight to the moon, and I own a lot of shares, and you would think this is good news. And it is. My portfolio overall is going up, but because I trade options, I do not want this stock going to the moon due to this one strategy called strangle, which I will explain what happened and also give you the lessons I learned using this strategy. I do something called a short strangle, and this is a separate video in of itself. But to make a long story short, in case you're not familiar with it, I make money if a price stays within this range. I basically set two strike prices, one on the lower end and one on the higher end. As long as the stock price doesn't hit this lower end or doesn't hit this higher end, I can take maximum profit. Now, the way I like to do my strangles is actually very risk adverse. I like to put my strangles roughly below 10 deltas. And what 10 deltas means is there's a less than 10% chance that the stock price will hit my strike prices. So what I did is after S&P announced that it was including Tesla, right here, Tesla experienced an over 10% swing up. And this is when I decided to sell the call end of a strangle because I assumed that the stock went up, it shouldn't go up that much more any higher. I put my strike prices ranging from 600 to 640. And at the time, when the price is at 450, 600 to 640 is a very unlikely number to hit. Those were roughly around 10 deltas, less than a 10% chance it would touch. These are very conservative plays. What I was not able to foresee though was that once the train started moving, that it would barrel out of control and never stop. Once we got over this hump, I thought that maybe I could wait it out. And remember, I just need to wait until my expiration date, which at the time was December 18th or December 24th. Those were my expiration dates. As long as the price expired under my strike prices of 600 to 640, I would still make money. But then it just never stopped. After this run up, I realized that I had to get out of these positions because I'm actually a big Tesla bull. And if I truly believe that Tesla is going to go up a lot more, then I don't want it to hit my strike prices, because if it were to hit my strike prices, I would need to sell my shares away at those strike prices. So as of today, this isn't fully updated, but this is roughly how much money I have made in the past 3 months trading essentially full time, mostly on my Tesla shares. The strategy I like to do means I make a little bit of money very often. I like to take money at 50%, as you can see the percent profit here. I've never gotten too greedy, but this is the black swan event that could happen, especially if I'm selling options. Basically, the price is just going up way too high, and these covered calls can't take the pressure. For me, as much as I like taking profit, I love my Tesla shares even more. So there is no price I'd be willing to pay to give away my shares. Basically, I was afraid that Tesla would go above 600. Imagine if it went up to 700. Now, what that would mean is, let's use this option as an example. Even if the Tesla share was at $700, the person that bought my contract, the person I sold my contract to, would be able to buy my shares for $600 per share. And that would mean I would get $60,000, which is nice. And I also made the premium they pay me, but that would be nowhere near the $70,000 that the shares would be currently worth, and I would be unable to buy back my shares. And $700 is a conservative estimate. Now I fear that it's funny that I use the word fear, but when you're selling covered calls, this is your greatest fear, that it goes up too high. So now my fear is that Tesla could hit 1,000 within a couple of months. I do think that's very unlikely, but the fact that there's a non-zero chance means that you and me need to be very careful with all of our covered calls. This market is absurd. Tesla is even more absurd in an absurd market. As you can see here, this is the amount of money I paid to close out these positions. Now, of course, I made a little bit of premium, roughly an average of $500 per of these plays. So while I add these up, this is total how much I've had to spend to close these positions. It's actually more like a net negative $7,300. Now, if we add that into my TD profit, that basically cuts the amount of money I made on TD in half. So before this happened, my total looked pretty good, but now minus 7,300. My profit has basically been slashed by a third, a little bit over a third. And I'm not gonna lie, this really hurts, but I'm glad that I made that decision. Today, we were about here when I bought those calls back. And at the time, I thought maybe I made a mistake because the stock started to drop, meaning I could have spent less money to buy to close those positions out. But then the rest of the day has proved my thesis right. Tesla is continuing to go up, which means where I attempt to close these positions right now, and it's about almost 3 o'clock p.m. Let's look at one of these positions. Let's look at the 600 strike call on December 24th expiration. If I were to try to close this position right now, I would have to spend $3,383. Luckily, because I did it in the morning, I only had to spend $2,700. This was already very painful because yesterday, if I had just closed it yesterday, let's look at Tesla's stock price. Yesterday at closing, we were at the 520s. So I had already made orders at the end of the day to close this at about 22.50. And then in the aftermarket hours, I saw that the price was ticking up. I had only just accepted I'd need to pay $2,000 to close this. And when I woke up today, the stock price was even higher, meaning this was even higher, and it took this much money to close it. And ouch. So now I'm going to give you some actual tangible takeaways. Take them as guidelines, but essentially for me, they're rules. I should not have sold so many calls all on the same day. I should taper when I sell my covered calls, because any one day it could seem like the stock price is high and we should sell there, but that puts a lot of risk on that one day, because the next day or 2 days from now or a week from now, the stock price could be a lot higher. So really choose your entry points better. A bad entry point right here, it doesn't matter that it was up here. If it just kept going up, this was a bad entry point. Another note is that if the market is turning against you, be ready and willing to cut your losses. I weighed out what was more important to me. Having all of my contracts potentially being called away at once was going to be a headache I wasn't prepared to deal with. If you are very bullish on a stock, make your strangles trend one direction. So during this period of time where Tesla is about to join the S&P 500, I should have played Delta 5s or below. If I was truly bullish on the stock, even Delta 10s were a little bit greedy. I should have taken less premium and given my strike prices even more space. Don't be too greedy on your strike prices. All it takes is one bad, incorrect play to do something like this. Now, in my defense, this is kind of a black swan situation. I don't know how many more run-ups like this Tesla will actually have. So all things considered, I think this is an okay outcome, and actually I feel pretty good about it. And this comes from the last lesson I learned, and this is about emotion. If you are emotionally not at a good place, that will affect your trading. Now, there's nothing super bad happening in my life, but with quarantine and not being able to do the activities I usually do, my mind was a little bit more fragile than I liked, and being in these positions was giving me a lot of anxiety. There was a part of me, my gut, that kept believing Tesla would go up, yet I was holding these call strike prices for very long at what ultimately turned out to be strike prices that are much too low. So it's kind of counter, but kind of trust your gut. And if you really don't feel good about something, either you're not ready for trading or just try to think about why you feel that way. And even when I talk to some of my friends, they aren't as big of a Tesla bull as me, so they couldn't understand why I was freaking out. I could still be wrong, but if you look at the trend right now, Tesla's gonna hit 600. The odds of that are very good. And any odds of my shares getting called away, I'm not willing to take that risk anymore. Anyways, please like and subscribe if that was helpful. How are your portfolios doing? What's your worst case scenario? This really was my worst case scenario. And the past 2 months have been so good. This was bound to happen, but I'm glad it's mostly over. I still have one strike price that's a little bit lower than I like at 640, but I'm already ready to buy that out if it becomes too close. This has hardened me to future incidents. This is Green Knight Trading, where Squires become Knights. Thank you all so much for watching, and I'll see you soon.